The earthquake didn't start in New York. It didn't start in London. And it didn't start with a crash on Wall Street. It started in a quiet room in Tokyo on a trading screen that most Americans never look at. On January 29, 2026, the most predictable, stable, and boring market in the world, the Japanese government bond market did something impossible. It broke. Yields on the 40 years Japanese bonds spiked above 4%. The 30-year yield jumped nearly 30 basis points in a single session. For decades, we were told this could never happen. We were told that Japan was zero land, a place where interest rates would stay at zero forever, where debt didn't matter, and where the central bank could control everything. But the control is gone. The anchor has snapped. And right now, a $10 trillion debt bomb is exploding in slow motion across the Pacific. You might be asking, why do I care about Japanese bonds? I live in America. I live in Europe. I hold dollars. You care because Japan is the largest foreign holder of US debt. You care because trillions of dollars in global investments, including the money pumping up US tech stocks, were funded by borrowing cheap Japanese yen. And now that money is rushing home. This is what we call the Convergence of Crisis. It is a systematic transmission of volatility from Tokyo directly to your 401k, your mortgage rate, and the value of the money in your pocket. I am the financial coin historian. Today, we are not just looking at charts. We are looking at the end of a 40-year economic era. We will expose the carry trade trap that has ensnared the global banking system. We will reveal the secret rate checks happening at the Federal Reserve. And we will show you why gold at $5,000 isn't a bubble, it's a fire alarm. The trigger has been pulled. The explosion is coming. Let's open the ledger. To understand the catastrophe unfolding right now, you have to understand the scale of the trap Japan has built for itself. Japan is the world's laboratory for debt. For 30 years, they ran an experiment. They borrowed and borrowed. They printed money to buy their own bonds. They kept interest rates at zero, sometimes even negative. The result is a national debt that is staggering. As of early 2026, Japan's general government gross debt stands at approximately 237% of its gross domestic product. Let me put that in perspective. If Japan's entire economy produces $100 of value, its government owes $237. The United States, which everyone criticizes for spending too much, sits at roughly 120%. Germany is at 62%. Japan is in a league of its own. For decades, this mountain of debt was manageable because of one simple trick. The interest rate was zero. When you pay 0% interest, it doesn't matter if you owe a quadrillion yen. The service cost is nothing. But the errors of zero land is dead. Inflation has returned to Japan. The cost of living is rising. The yen has collapsed in value because they printed too much of it. So, the Bank of Japan was forced to do the one thing it cannot afford to do: raise interest rates. On December 19, 2025, they raised the policy rate to 0.75%. It sounds small, but on a debt pile of 1.3 quadrillion yen, even a fraction of a percent increase is a mathematical disaster. The cost of servicing this debt has exploded. Servicing the debt, just paying the interest and redeeming bonds, now consumes nearly 31.3 trillion yen annually. When you combine debt payments with Social Security for Japan's aging population, these two items alone consume nearly 60% of the entire government budget. Think about that. 60% of the country's money is gone before they pay a single police officer, build a single road, or fund a single school. This is the debt trigger. The math no longer works. If yields rise further, Japan becomes insolvent. If they print money to lower yields, the currency collapses. They are trapped. And when a giant is trapped, it thrashes. And that thrashing is about to hit you. Markets are like gunpowder. They are dangerous, but stable until someone lights a match. In January 2026, the Prime Minister of Japan lit the match. Prime Minister Sayataki is facing a desperate election on February 8th. Her approval ratings are wobbling. The Japanese people are angry about inflation. So she did what politicians always do. She promised free money. She announced a plan to suspend the consumption tax on food. She announced a massive stimulus package worth 21.3 trillion yen. Cash handouts, utility subsidies. To a voter, this sounds great. To a bond trader, this sounds like suicide. The bond vigilantes, the investors who control the debt markets, looked at her plan and panicked. They asked a simple question. You already owed 237% of GDP. You're already struggling to pay interest. And now you want to cut your tax revenue and increase your spending. Who is going to pay for this? The answer was nobody. Investors realized that the Japanese government had abandoned fiscal discipline. They realized that the primary balance target, the goal of balancing the budget, had been thrown in the trash. So they sold. They sold Japanese government bonds aggressively. When you sell bonds, the price goes down and the yield goes up. This is why the 40-year yield hit 4%. It wasn't just economics. It was a vote of no confidence in the Japanese government. This is the Takuchi shock. It proved that the government is willing to destroy the bond market to win an election. And as yields spike in Tokyo, they send a signal to the rest of the world. The risk-free rate is no longer risk-free. But the real danger isn't just inside Japan. The real danger is the hidden web that connects Tokyo to New York. Now we arrive at the transmission mechanism. How does a crisis in Japan crash the stock market in America? The answer lies in two words: carry trade. This is the invisible engine of global finance, and it is about to seize up. For 20 years, Japan had the lowest interest rates in the world, often zero. Global hedge funds, banks, and institutional investors realized they could do something clever. They could borrow money in yen for free. They took that borrowed yen, converted it into US dollars, and bought assets that paid a higher return. They bought US Treasury bonds paying 4%. They bought Nvidia and Microsoft stocks. They bought high-yield corporate debt. It was free money. You borrow at 0%, you earn 5% or 10% or 50% in the stock market. You pocket the difference. This trade grew to an estimated size of $1.2 trillion. Trillions of dollars of asset purchases in the West were funded by cheap loans from the East. But the carry trade has a fatal flaw. It only works if the yen stays weak and Japanese interest rates stay low. Now look at what is happening. Japanese rates are rising to 0.75%, maybe higher. The yen is strengthening because the Bank of Japan is intervening. The free money is no longer free. In fact, it is becoming expensive. Investors are now facing a margin call on a global scale. To pay back their yen loans, they have to sell the assets they bought. They have to sell the US tech stocks. They have to sell the US Treasury bonds. This is the unwind. It creates a vicious cycle. As they sell US assets to buy yen, the yen gets stronger. As the yen gets stronger, the loans become even more expensive to pay back for other investors. So, more investors are forced to sell. We saw a preview of this in August 2024. A small rate hike in Japan caused a global meltdown that erased $6.4 trillion in value. But that was a tremor. This is the earthquake because this time inflation in Japan is real. The Bank of Japan cannot just cut rates to save the market. They have to keep hiking. The carry trade is being dismantled brick by brick, and every brick removed is liquidity leaving the US market. The most terrifying part of this unwind is happening in the most important market on earth, the US Treasury market. Japan is the largest foreign owner of US government debt. They hold over $1.2 trillion of US Treasuries. These are held by the lifers, Japanese life insurance companies, and pension funds. For years, they bought US debt because it paid more than Japanese debt. But now, the math has flipped. The cost of hedging, protecting against currency fluctuations, has skyrocketed. If a Japanese investor buys a 10-year US Treasury bond today and pays to hedge the currency risk, the effective yield is actually negative. Why would they buy US debt to lose money when they can now buy a domestic Japanese bond yielding nearly 2% risk-free? They wouldn't, and they aren't. We are seeing the Great Repatriation. Japanese institutions are stopping their purchases of US debt. And worse, they are starting to sell what they already hold. They need the cash to cover losses at home. They need the cash to pay out claims in an aging society. Think about the timing. The US government is running a deficit of $2 trillion a year. They need to sell more bonds than ever before. And at the exact moment America needs to borrow record amounts, its biggest lender is walking away from the table. This creates a supply and demand crisis. Too many US bonds for sale. Not enough buyers. Basic economics tells us what happens next. The price of bonds collapses. The yields spike. We saw this in late January when a Japanese bond auction failed. US Treasury yields immediately spiked to 4.9%. This is the contagion. Japan's debt crisis is forcing US interest rates higher. The US Federal Reserve has lost control of the long end of the curve. They can set the overnight rate, but Tokyo is setting the 10-year rate. And as we will see, when the 10-year rate spikes, the American economy breaks. Do you own stocks? Do you have a 401k? Do you invest in tech? Then you need to pay attention to this correlation. Data from early 2026 reveals a startling mathematical relationship. Every 100 basis point rise in Japanese government bond yields has coincided with an approximately 5% decline in the Nasdaq. Why are Silicon Valley and Tokyo linked so tightly? Because the US tech sector was the biggest beneficiary of the carry trade. Tech stocks are long-duration assets. Their value is based on earnings far in the future. These stocks thrive on cheap liquidity. When money is free, you can bet on AI. You can bet on the metaverse. You can bet on growth. But when the cost of global capital rises driven by Japan OS normalization, the valuation of these companies gets crushed. Furthermore, the hedge funds that are leveraged into these stocks are the ones using yen funding. When they get a margin call from Tokyo, they don't sell their Japanese bonds. They sell what is liquid. They sell Apple. They sell Nvidia. They sell Amazon. They sell their winners to pay for their losers. This creates a wave of selling pressure that has nothing to do with the earnings of the companies. Apple could report record profits, but if a massive hedge fund in London needs to repay a yen loan, they will dump Apple stock. This is why the market feels so volatile. It is being driven by liquidity flows, not fundamentals. In a worst-case scenario, a disorderly breakdown of the Japanese bond market. Analysts project the US stock market could decline by 20 to 30%. The Japan shock is the pin looking for the AI bubble. The pain doesn't stop at the stock market. It hits you where you live. US mortgage rates are tied directly to the 10-year and 30-year Treasury yields. When Japanese institutions sell US Treasuries, yields go up. When yields go up, mortgage rates go up. In late January, as the Japanese crisis worsened, the US 30-year yield breached 5%. This pushes mortgage rates toward 8% or higher. We're already in a housing affordability crisis. The average American cannot afford the average home. Japan's debt crisis is making it impossible for the Federal Reserve to lower rates significantly. Even if the Fed cuts the short-term rate, the long-term rate, the one that matters for your house, is being held up by the selling coming from Tokyo. This is the yield linkage. An elderly retiree in Kyoto selling a bond to pay for his pension causes a young couple in Ohio to lose their mortgage approval. The global financial system is that interconnected. And right now, it is that fragile. Governments are not sitting idly by. They see the tsunami coming, and they are plotting a desperate defense. Whispers are circulating in high-level financial circles about a new agreement, the Mar-a-Lago Accord. This is a rumored coordinated intervention between the US Treasury and the Japanese Ministry of Finance. We have seen the signs. On Friday, January 24th, the New York Federal Reserve conducted a rate check. They called major banks and asked for quotes on the yen. In the diplomatic language of central banking, a rate check is like cocking a gun. It is a warning. It means we are watching and we might shoot. The goal of this accord would be to weaken the US dollar and strengthen the yen artificially. Why? For Japan, a stronger yen lowers the cost of energy and food, helping Taichi win the election. For the US, a weaker dollar helps exports, but more importantly, it helps devalue the massive US debt pile. If they can coordinate a devaluation of the dollar, they might be able to stop the carry trade from unwinding too violently. But there is a catch. Currency intervention rarely works for long. To support the yen, Japan has to sell US Treasuries. That pushes US rates up. To support the bond market, the US Fed has to buy Treasuries. That creates inflation. They are playing a game of wakuo. Every time they hammer down one problem, another one pops up. And usually the thing that pops up is inflation for you and me. So how does this end? Based on the deep research, we are looking at 3 possible scenarios for the remainder of 2026. Scenario A, the orderly normalization. Probability 30%. In this world, Takaichi moderates her spending plans. The Bank of Japan raises rates very slowly. The carry trade unwinds over 2 years, not 2 weeks. Markets hurt, but they don't crash. Scenario B, the volatile adjustment. Probability 50%. This is the most likely outcome. Japan continues to tighten. Markets experience multiple flash crashes like we saw in January. The US stock market ends the year down 10%. Gold acts as the only reliable hedge. Scenario C, the disorderly breakdown. Probability 20%. This is the nightmare. The Japanese bond market loses liquidity. Yields spike vertically. The yen carry trade collapses all at once. Global margin calls trigger a 30% crash in US equities. The Federal Reserve is forced to restart QE to save the Treasury market, triggering a second wave of inflation. The Japan debt trigger is live. The safety is off. In a world where government bonds are crashing and currencies are being manipulated by secret accords, where do you hide? The research is clear. The safe haven has shifted. Government bonds used to be the risk-free asset. Now they are the source of risk. Capital is fleeing toward hard assets. This is why gold has hit record highs, targeting $5,000. This is why silver is surging toward $100. Investors are realizing that if Japan has to print money to save its bond market, and if the US has to print money to buy the bonds Japan is selling, then fiat currency is going to lose value rapidly. Gold and silver are the only assets that are not someone else's liability. They are not part of the carry trade. They do not depend on the Bank of Japan's yield curve control. The convergence of crisis is a signal to get out of paper promises and into physical reality. The old rule was 60-40 stocks and bonds. The new rule is defense first, cash reserves for liquidity, precious metals for insurance, and a deep skepticism of any politician promising free money. Japan is the canary in the coal mine. It is showing us what happens when a modern wealthy nation reaches the end of its debt capacity. For 30 years, they delayed the reckoning. They used every trick in the book. But math always wins in the end. The explosion in Tokyo is the sound of math winning. The shock waves are crossing the ocean right now. They will hit your portfolio. They will hit your currency. Do not be the person who ignored the rumble in the distance. The debt trigger has been pulled. Prepare accordingly.